Okay, good afternoon. So we are in this is the fast forward now. We are saying the afternoon. Okay, so good afternoon. Welcome to today's strategic financial management class. So we are going to continue from where we stopped in our last class. So last class we were looking at NPV and the major adjustment that we need to know. Major adjustment that we need to know with respect to cash flows. So we look at NPV and inflation. We look at real and nominal. We've also talked about NPV and taxation. We also talk about taxable on capital allowance, how to make the necessary adjustments, and also on tax also, when you are seeing tax in the question, what and what are you expected to, the necessary adjustment that you are expected to make. So we actually talk about all those ones. So today, we'll be looking at the final one, and that is we're looking at NPV and working capital. Because working capital also is another adjustment that we need to know how to carry out the adjustment in the exam. Okay, so when you say working capital, what are the necessary adjustments that we need to know with respect to it? So working capital, as we all know, for every project, working capital is like the capital that is needed for day-to-day operations. You know, as you are looking at that project, you are trying to execute that project on a daily basis, you need working capital for the operations. Are we getting it now? So how do you treat working capital with respect to investment appraisal? So that is what we want to look at. So what are the things that you need to know as far as working capital is concerned? First one is that the fact that is relevant with respect to NPV, it is the incremental working capital. It's the incremental working capital. This is what we need. It's only the incremental. You don't need the total working capital. It is the incremental working capital. So how do you get that incremental working capital? We are going to look at that. The second part that is relevant to NPV, it is that you have to recoup your working capital at the end of a project. The need to recoup working capital as the end at the end of the project. So these are the two statements that speak to working capital. When you are necessary adjustments that you need to carry out with respect to working capital, there are two. You should know that in your NPV analysis, you need only the incremental working capital. That is one. The second one is that you need to recoup the working capital at the end of the project. How do you determine the incremental? How do you recoup? So let's look at this example. Let's look at this example. let's assume a working capital of 20,000 of what 10,000 as the beginning at the beginning of the project. And it's subject to 3% inflation. It's subject to 3% inflation for 5 years. Assume a working capital of 20,000 at the beginning of the project and is subject to 3% inflation for 5 years. So what part of the working capital is relevant? We said it is the incremental. So how do you get the incremental working capital? So solution. Now, let's say the project is for 5 years project. We have the years. Year 0, year 1, year 2, year 3, year 4, and year 5. Yes, to year 5. So we have working.
Please, I just come here, sir.
Okay. So up to year 5. Now, let me ask this question. If we are looking at a project, we know that projects always start from year 0 to, let's say, year 5 for 20 years. Are we getting it now? At what point in time, at what point in the life of the project do you need working capital? Is it at the beginning? Is it at the beginning of the year or at the end of the year? You know, there are two different things. Beginning of the year. At the beginning of the year. The question is, at what point do you need working capital? Is it at the beginning of the year or at the end of the year? Can be at the beginning.
At the beginning.
Beginning.
At the beginning.
At the end of the
At the end.
No. We are saying, wait, don't miss anything. No. We are talking about working capital now.
Yes.
We are not talking about any other thing. Working capital.
So I feel if you start at the beginning, you can start either but the working capital generally.
Where do you need working capital?
At the beginning.
Working capital is always at the beginning.
Yeah.
Are you getting it now? Let me ask this question. When is the beginning of the one? Sure, you understand. So you always need working capital at the beginning of the project life. Are you getting it now? So meaning that if you are looking at this, assume a working capital of 20,000 at the beginning of the project, and is subject to 3% inflation for 5 years. And we said, with respect to working capital, we need only the incremental. Now, that 20,000 will be in what? Under year 0, 20,000. So that is the beginning. The working capital that you need in year 1, it will be in year 0. Are you getting it now?
Yes.
Because you assume every other cash flow will occur at the end of that year. But the working capital is not going to follow the same thing. It's going to be at the beginning. Are you getting it now? Now, so if 20,000 is at the beginning, which is under year 0, and is subject to 3% inflation. Now, 20,000 at the beginning, what is going to be the working capital in year 1? If it's subject to 3% inflation, it's going to be what?
20,600.
600.
20,600.
600.
So we are going to use
21.
What is
incremental part of it.
this was? Yes, we are. What we are getting now is the total.
Yes.
If you have 20,000 in year zero and it's subject to 3% inflation, what is going to be the total? I get it now. 20,600. In year two, what is going to be?
21,000.
What are you just doing? You are just multiplying 1.03 times what we are having here. That is what? 21,200. 218. Okay. 21,218. In year three, 21,855. And in year four, 22,510. Do we put in year five?
No.
You recoup in. So what are we going to put in year five?
23.
What is it worth?
23.5.
Let's find
incremental part.
incremental value.
Okay. Now let me explain something here. Now, the working capital, the 5 years is for 5 years, 5 years project.
Yes.
The 20,000 that we put here is what is needed in year one. Right? The one that we put in year one is what is needed in year two. The one we put in year two is what is needed in year three. The one we put in year three is what is needed in year four. The one we put in year four is what is needed in year five. If you now go ahead and put anything in year five, what is needed in year six, and the project life is what? 5 years. Are you getting it now? So you don't put anything here, it's zero. Forget about the recouping, I will explain that one. But for now, just understand the working capital. So what we have done here is we have calculated the total working capital of each year. Are you getting it now? So what we need in our analysis is incremental working capital. How do we get the incremental working capital? We need 20,000 in year zero, right? This is what we needed. This is what we needed. But we now increase it by 3%, which is 600. Meaning that is the differential we are talking about here. In year zero, we started with 20,000. At the end of year one, we have 20,600. It's not we added 20,600. We only added what? 600. So that means we are finding the difference. So the difference is what? 600 years. In year two, between year two and year three. Is it between year two and year three?
Year one,
Year one and year two. At the end of year one, we have 20,600. But at the end of year two, we have this. What is the difference?
618.
618. Yeah, what is the difference?
637.
637. Yeah, what is the difference?
655. 655.
This one?
No, the next one.
655.
655. The difference between this and this is what?
22.
So we say, when you say you recoup, you have to understand. When you say you recoup, you have to understand what we are saying. Now, what does it mean? It means that for all the working capital and all the increment, when you add everything together, to give you this. Are you getting it now? So this is what it meant by you recouping your working capital at the end of the project life. At the beginning, you introduce 20,000 and you introduce additional up to the end of the project life. So when you add everything together, it should give us 22,510. So this is what
No.
the incremental. Yes, all this incremental. You are introducing cash in their outflow. And at the end of the project life, everything, you get everything back.
Get everything done.
You recoup. That's what it means. You recoup your working capital. Don't forget, we said there are two things that we need to take notes under working capital. How to determine the incremental. These are the incremental. The next one is to recoup the working capital at the end of the project's life. At the beginning, you will lose 20,000. Are you getting it now?
Yes.
And they keep on increasing by 3%. Are you getting it now? So when you add everything together, all the increments and what we introduced initially, everything should be what we are getting back. You are getting the working capital back. That's to say you recouping the working capital at the end of the project life. So when you see working capital in any question, this is what we are expected to follow. The two things that speaks to it. Okay. So that is all the necessary adjustment that we need to make as far as NPV is concerned. So let me now give us the formats, all the NPV formats. And see NPV question, where do you start from? So it's going to be very, you see the question that I shared?
Yes.
Okay, so we have to know where to start from. So I will give the formats and you follow the format accordingly in every question. Can I open it up?
Yes.
Okay. You know what? Now, the what?
I said our class captain is wrong, please.
Yes,
I know they do. I know they do. And they do. That's so. You don't say amen. Don't mind that. Amen. Yes. Don't like probably say.
let's say for 4 years projects.
Let's give it format.
Yes. Now, for 4 years
You shall
projects,
just become. You shall just become.
okay. So NPV format. Let me put it like this. 4 years. Let's say 4 years projects. Cost of time. Okay. So where do you start from? NPV format. 4 years project. So we all start from. You have to determine your years first. The years is going to be from year 0, year 1, year 2, year 3, year 4. Now, there's one thing that you need to consider here. Do we need to create for year 5 or you stop at year 4? Lots of tax. Are you getting it? So you have to take note of that because some people will create for 4 years and you now be looking for where they will put for tax and they have exhausted the space of the if the tax again, it's going to affect your calculation also.
The last one. Yes.
No. If there's no need, if the tax is in relevant years, are you getting it now? So your 4 years will be 4 years. Nothing will be extended to 5th year.
But we already know that we pay tax.
Yes, it depends on the question. So if the question says tax in relevant years, are you getting it now? So your 4 years will be 4 years. So if there's a year delay, if there's a year delay,
Is it component?
yeah, because there's something that's going to be there. The tax,
That's the
yes, now, it's going to affect your everything. You are not for it also and everything. It affects your calculation. Okay, so it's good that you take note of that. Another thing to take note of is the currency. Are you getting it now? I think mostly it has been naira. So naira. Another thing you take note is the what? Is the thousands, million, and the like. So there's no point in you writing 0000. Just look at the. Don't be getting. Don't be busy with them. So look at the highest. The highest figure in the question. If the highest figure is if it is in millions, are you getting it now?
Yeah.
If it is millions, just stick to that millions like that. If it is billions, are you getting it now? You have to be very careful. You can use millions, I think, or you use thousands, depending on the highest amount of money in that question. If the highest amount is millions, you can use thousand. If the highest amount is billion, you can use million. Are you getting it now? Okay. So you have to indicate.
Mr. Razak,
Yes, sir.
please, you made mention of when we were talking about the years, the taxation. So what if in the question they said tax is paid in arrears? It means we'll be needing year 5, right?
Yes.
So if it is in arrears, that is there's a year delay in tax. So if the project is 4 years, there's going to be an extension to 50 years to accommodate the extension of tax of 4 years to be paid in year 5.
Okay, thank you.
So after indicating all this, so you start with your revenue. So definitely revenue. Don't forget, in most questions, the revenue will be determined by your selling price times quantity, mostly. So you put your revenue. The next thing is to determine your variable cost. Most cases, your variable cost will be determined by the variable cost per unit multiplied by quantities. So it's a cost, and put it in brackets. The next thing to determine is the specific fixed cost. Don't forget, we say we have 2 types of fixed costs, specific and general. The specific that is relevant, general are not relevant. Okay, specific fixed cost, determine that also. After determining your specific fixed cost, you need to get the cash profit. After getting your cash profit, we said immediately you get profits, you need to determine your tax. Tax at a particular percentage. So determine your tax. Tax is an outflow, put it in brackets. Question. Okay. Research and development. So it depends on how that statement is structured. Are you getting it now? So the sum, you cannot just generalize that research and development should be relevant, depending on how it is given to you in the question. If that research and development is going to lead to improvements of that project, are you getting it now? So it's specific to that project, so you use it. So if it is just not having any impact, are you getting it now? So we don't.
Like I'm asking that it's relevant.
So research and development is a cost. Are you getting it now? It will be part of all this. All these things not aligning very well.
So you are doing the tax paid very here. Otherwise,
yes, otherwise
there won't have been any
there won't have been anything you want. There will have been 4 years. Okay. So that is tax. Immediately after tax. Now, there's one thing here. After revenue, variable cost, specific cost. If there is any other direct cost for that project, take note of them also. Are you getting it? So after tax, you take care of tax saved. Tax saved on capital allowance. And tax saved on capital allowance and inflow. So after tax saved on capital allowance, you need to take care of
That means the tax sale to be extended to private.
yes, the tax saved on capital allowance also.
That's what it says.
Like I explained the last time. In some questions, the timing of tax is different from saving on capital allowance. Are you getting it now? If you are not giving the tax saving on capital allowance, like the timing of capital allowance, are you getting it now? You assume the same thing of tax. But if this one is given differently, follow the rules given to you. That's how we talk about at the beginning, at the end. Are you getting it now? You just have to read through the question. So immediately after this, you consider the capital items. So what are the capital items? Talking about the initial outlay. The initial outlay obviously will be year 0. So we put it there. Initial outlay. What other items is falls under capital items? Working capital. So the working capital, don't forget, is only the incremental that we need.
Yeah.
You need only the incremental. Can we have this under year 0?
No.
Okay. So working capital incremental can outflow is there accordingly. So in year 4, what do you do to the working capital? You say you will, so it's not going to be
Rasaq,
yes.
you say that working capital, are you saying that working capital cannot start at year 0?
The working capital, you have the initial amount, like the example that we did, the amount introduced, incremental, and you recoup. Are you getting it now? So
Okay.
okay, fine. What you have in year 0 is the amount introduced at the beginning. The incremental follows, and you recoup. When you add everything together to give you what you should be having here, that is you getting the working capital back. Are you getting it? Okay.
So we don't need that one to explain now. We still get
This one. Yeah, this is what we introduce. That is the initial amount introduced, and the incremental follows, and you recoup.
Is
Okay.
it all working capitals that will always be in year 0?
Is it what?
Initial. Is it in all questions? Is it applicable in all questions that the working capital will always be, the initial will always be in year 0?
Yes.
Or
The
I
working capital should be at the beginning. At the beginning, if the project is starting in year 0, so that is where working capital is needed. So for the subsequent year, it's going to be the incremental, the additional that we are adding to that initial one. And at the end of the project life, you expect to recoup it. So meaning that when you add everything together, to be equal to what you are having at the end of the project life. Any other capital items? Residual value.
Please help us adjust the camera to the left. You cannot.
Residual value. So residual value should be at where? At the end of the project. Is it an inflow or outflow? Inflow. Okay. There is something as value. So that is that. Any other items? If there's no any other items, so you do the minusing to get your net cash flow. So whenever you get here, this should be in brackets. This one, you have this. So once you get the net cash flow, the next thing is to introduce your discount factor at a particular percentage. So you are discounting. You are discounting. Net cash flow, it's not. It's only year 0 that is. You can by implication say that it should be in bracket, but anything can happen in between the line. Because let's have positive also. Okay. And after this, we are getting your present value. And when you add everything together, inclusive of your initial outlay, getting NPV. So when you add everything together with all this, you are going to get NPV. Meaning that in every NPV question, you should know where to start from. That is the essence of this format. Get your revenue first. How do you get your revenue? In some question, you might be given. Some question, you need to multiply the selling price with the quantity. It's a lot of work, so are you getting it now? Very, very nice. No issue now.
I just told you that this was
Yeah, it just have to do with it like that. Okay. Now this is the format. So when you are looking at first one, you know where to start from and how to carry out all the necessary adjustments. So that is
the question you might be hearing the past for the truth. The question might be, but this correction now. Yeah, it's possible.
No, it's possible. They just want you to carry on multiple adjustments. But it's not going to be a composite question, though. Maybe the one that follows.
This will be a common question.
Okay. So now we have done everything about NPV. You've done the one that will give you the cash flow and the one that you need to generate it by yourself. So this is how to generate the net cash flow by yourself. Are you getting it now? So now let's look at another technique. Before we now look at that question together, a question can be used to solve to do 4 techniques together. You can use a question to calculate NPV, internal rate of return, modified, and discounted payback. So that's what we want to do with that question that I shared. So that is that about NPV. Now let's pick another discounting technique called internal rate of return.
That's all about NPV.
Yes.
This question is to give us this, right?
Yes, it's so we are going to solve it, but we have to talk about other techniques. So we now use the same question to address all those techniques: internal rate of return, modified, and discounted payback. So we know that we are doing with all those ones. Can I know what this? What was? Now let's look at internal rate of return. What is internal rate of return? How do you explain that to a footballer?
How do they explain that corner kick to me?
How do you do what?
How would they explain that corner kick to me? We all have our own slogans.
Okay, another technique that I'm looking at the level the two. This correctional class is higher. Okay. So internal rate of return is another discounted technique that you can use to determine the profitability of a project or otherwise. So I'm asking, what is internal rate of return? Someone said is what? He said when MPV is equal to 0. Is the what? It's the rate that makes MPV to be equal to 0.
Wow.
So I mean, people like, how do you explain that to me?
The cost of investment. That they don't make any profit, but the way that it will match.
At least, worst case scenario.
Yeah.
Okay. If you say that, okay, it's the rate that will make me to break even, that I will neither make profit nor loss. It makes some sense. I still understand. That if I invest, I'm not. Okay. Now, the rate that make NPV to be equal to 0. Now, let me explain two things here. There's what is called cost of capital. We have not done it, but I know we have not idea about it. Cost of capital and internal rate of return. The two of them, what is the difference between the two?
One, this one. Cost of capital.
Measure what?
What is the discount?
Which of them?
Cost of capital.
Is what? Between what? Internal rate of return and cost of capital. Are they the same?
No, one is the one aspect of cost of capital. One is I don't know what I can say. One has to be
Those online, can you help out?
Hello, sir.
What is the difference between internal rate of return and cost of capital?
Cost of capital deals with both the equity and debt holder, the return. Then while the internal rate of return is only for equity holder, the return they get from the investment. Thank you.
So I the rate.
Wait. You know what? Before you explain, just make it simple. A literal meaning different between the two. Just understanding how you understand it.
So cost of capital is like the cost that you incur to get capital. But IRR is like simply it's taking into cognizance the cost of the entire investment and not just the additional cost that you have to incur for the capital.
You are not far from it. But let me just put it literally. Are you getting now? When you say cost of capital is to the company. Are you getting it now? Why internal rate of return is to the investor? Are you getting it now? So, yeah, wait. Cost of capital is the cost that the company has to incur to secure that capital. Where is the company securing the capital from? From investors. Take for instance, you want to invest, you are placing a project, or you want to invest in a project. I'm looking at the company side now, and you need 1 million naira, and you don't have this 1 million naira, and you approach a bank that you need this 1 million naira, and the bank is saying that before we give you this 1 million naira, we are going to charge you interest of 18%. Are you getting it now? This 18% to bank is rate of return they are expecting on this 1 million. Are you getting it now? Why to the company that has gone to borrow this 1 million? It's the cost of capital to this company. The cost of securing the capital, of securing this 1 million is 18%. Are you getting it now? Meaning that the company that has gone to borrow this 1 million will use this 18% to appraise every project. Are you getting it now? So the project must give the company, in worst case scenario, this 18% to break even. Are you getting it now? Anything less than this 18% is going to be a lost project. The company will not be able to pay the bank this 1 million and all the interest on it. Are you getting it now? So meaning that depending on whose side are you defining, you are defining the internal rate of return. Internal rate of return is directly to the investor. Are you getting it now? While cost of capital is directly to the what? To the company. Are you getting it now? The cost of capital. How do you secure that capital? What is the rate? Are you getting it now? What is the rate that you have to ensure that you give back to the investor? That is the cost of capital. And you must get the worst case scenario is to get 80%. You must not get less than below. That is when we are saying if we don't say if the internal rate of return is greater than cost of capital, we should accept. If the internal rate of return is less than cost of capital, reject. If internal rate of return is equal to cost of capital, is breaking even. Are you getting it now? The internal rate of return is what the investor are expecting to get. Are you getting it now? For investing in that company, this bank for giving you this 1 million. What they are expecting is 80%. Are you getting it now? So that means that from that project must either give 80% or more, must not give less. Are you getting it now? So that is the internal rate of return. So the rate that you can use to determine whether that project is profitable or not is when you use the rate and the NPV is equal to 0. That's why we say internal rate of return is the rate that will make NPV to be equal to 0. Are you getting it now? That is the worst case scenario to break even. And we said when the NPV is positive, it means that the project is what? It's profitable. Are you getting it now? When it is negative, it's a loss project. When it is equal to 0, you are breaking even. Are you getting it now? So that is it. Is that clear now? So we can give, there's one thing about exam. If you explain it based on your understanding, I get it now. You'll be able to take advantage of more lines. I get it now. But if it is the way it is in textbook, you cannot be able to write more than 2 lines when you are explaining. I get it now. But if you are explaining from your own understanding, you can do like 6 to 7 lines, and that also counts for something. When they are looking for where to give you 1, I get it now. They can just like, okay, let me add it here. And you get your 1 and you move on. Okay. So
Hello, sir.
is.
Hello, sir.
Yes, sir.
Hello, sir.
Yes, I'm with you.
Hello, sir. Please come again with this IRR. Please come again with this IRR greater than COC, less than and then equal to. Please, I didn't get that part well.
Yes,
Sorry.
we are going to get there. I'm just explaining this one. It's part of what I'm going to give out. Right? Okay. Now, that is internal rate of return. So how do we calculate internal rate of return now? To calculate internal rate of return is based on trial and error. Are you getting it now? Yeah. You assume. Now, what do you need to calculate internal rate of return? You need positive NPV, and it was corresponding discount factor. And you also need negative NPV, and it was corresponding discount factor. So you need to get this two. Are you getting it now? To calculate internal rate
The first one, the first one, okay, positive
NPV and its corresponding discount factor. The second one is the negative NPV and its corresponding discount factor. The formula. So IRR formula is lower percentage. The what? The formula. Yeah. Okay, so
I was like, this because today because formula.
is it here?
No. Don't because
But it's not hard now. Lower percentage plus NPV positive divided by equity positive.
I don't want to know the kind of things I'm doing.
Yes. Okay. Yeah. Yeah, percentage is the lower percentage. The NPV positive. This is the positive NPV. NPV minus is the negative, and the H percentage there is the higher Okay, so that is the formula. What is the decision? Decision. So the decision is going to be based on if internal rate of return, depending on the question the other time. So this is the focus. The internal rate of return, if it's greater than cost of capital, you accept the project. It means that the project is what?
Please adjust camera, sir.
It means that the project is profitable. So if internal rate of return, if it is less than the cost of capital, it means that it was a loss project. You will reject the project. That is, your recommendation should be that the project should not be undertaken. And we can have a situation whereby the internal rate of return is equal to the cost of capital. Here, what happens here? You break even. You break even, you can recommend an indifferent position. You neither make profits nor loss. So, what is the indication? Internal rate of return greater than cost of capital. Meaning that what you are getting from that project is more than what you want to do and give to people that the investors. Are you getting it now? So the investors can be an individual and it can be a financial institution. Are you getting it now? So what if what you are getting from the project is more than what you want to go and give to the investors? You think that that project is a profitable project. I hope that is clear. I think so. You think so? Yeah.
Please repeat this explanation.
Sir, what are you against if it's against what?
Exactly. I like that person. You know, we came out last time. Yes, that's what I mean. Different between one and so if you tell you if it's against the one, most of the president that about like no, it's better than that's of debt. Of debt. Oh, no, that's part of capital. It's part of capital. The next five whether
Now, let me clear that part. Let me clear that part. When you say we are not there yet, though, cost of capital. Cost of capital is COC now.
Yes, no.
Are you getting it now? And you have the weighted average cost of capital. So what is the difference between the two? Is there any difference?
Depends on the
Is it weighted? What are you weighted?
What's rated? Yeah. It's two different things.
Yeah, they are not different. It depends on the source of capital of that company. For a company that has raised finance, there are two ways that you can raise finance. You can raise finance through equity and through what?
Yes.
Yes. Are you getting it now? So if you have raised money through equity, your cost of capital is going to be your what? It's going to be the same thing as a what now?
Yeah.
Yes. Are you getting it now? If you are all equity finance company, all equity finance. All equity finance companies, their cost of capital will be equal to their work. Are you getting it now? But for a GL company, when you say a GL company, the company that has debt in its capital structure. Are you getting it now? So it's cost of capital. Are you getting it now? It's cost of capital is going to be its weighted average. So it's not going to be cost of capital only. It's going to be weighted average cost of capital. What are you finding the average? You are finding the average between equity and what? And debt. You are combining the two together. So you don't use cost of capital for a GL company. You use weighted average cost of capital for a GL company. A company that has both equity and debt in its capital structure. Are you getting it now? So an examiner can ask you the difference between cost of capital and weighted average cost of capital. I hope that is clear. Is it clear now?
Yes.
So all these things they are direct. Are you getting it now? So we just have to get the understanding. Okay. Are you clear with all this? No, you see the person.
Structure of the company.
It's still the same thing. Are you getting it now? So you can see, you can have IRR greater than WACC. That means that company is a GL company. Are you getting it now? So the same thing. Meaning that company is owing both the equity holder and debt holder. So the interest of the fund must be greater than the WACC because the company is owing the equity holder and debt holder. So if the IRR, are you getting it now? It's less than the WACC. That means the company will not be able to pay the equity holder and debt holder. But that project is not, it's a loss project. So it should be greater than, because this is the maximum amount that the investors are expecting to get. Are you getting it now? That is the explanation there. So we have to look at the question under this one. We should not. It's waste of time. So let's explain another technique. 519. Let's look at modify internal rate of return. Let me rub up this. Modified internal rate of now modified internal rate of return. Now, the reason behind this modified internal rate of return is this. Okay, let me also say this. You might be looking at two different investments. And the question we ask people to use modified internal rate of what's it called? NPV and IRR. Are you getting it now? Now on that basis, I should make a recommendation. Take for instance that NPV is positive for that project. And internal rate of return for that project is greater than cost of capital. On the basis of these two, which of them will you recommend and why? We are looking at the project. The NPV for that project is positive. Likewise, the internal rate of return is also greater than the cost of capital. If the two projects, if the two projects are mutually exclusive, typically that cannot do the two at the same time. You have to take one. So what will you do?
So we consider the positive NPV project.
Why? Why?
Okay, the reason is because the positive NPV project is more realistic, while the IRR is based on certain assumptions.
Example. But it's so simple. You can do I get it now. You can see the reply. You can see the response. Yeah. So that is it.
Say it again.
Louder. They are doubting you. Say it again. Which answer? I said you say it again. Why the IRR is based on what? It's based on assumption. Now.
IRR is conducted on the analysis of NP. So that IRP is more accurate than.
No, that's not the basis of. It's not. No. You cannot say no. You cannot say it because it's calculated on the based on
If NP are manipulated, how are you going to get accurate IRR?
So how do you? Is there any room to manipulate NPV? Do you make any assumption on that NPV?
No.
Yes.
No.
No.
Yeah.
No. Wrong answer.
Your answer will be wrong to your.
Is the expected the cash flows, the cash flows, assumption.
That's because it's conducted on the assumption of the.
Yes, that is the practical.
Hello, please, but we can't hear anything.
Oh yeah, it's all. Your network is not good though. Oh yeah. Let's continue. Okay, now, so another.
Even the period of time you are assumption.
What do you say? Yes, sir. The what? The network is not that clear. Okay, so that is one of the perfect answer. Are you getting it down? The second one is that under the NPV, you get the absolute amount. What you are getting, if your NPV is 10,000, that is the 10,000 you are getting on that project. Are you getting it now? Absolute amount. But under the internal rate of return, is what you are getting is what? It's relative to the cost of capital. Are you getting it now? It's relative, it's not absolute. And it is what? It is always too juicy. You know, when you look at the internal rate of return, you are saying that 20% return. It sounds so juicy, but you don't know what is going to happen, whether you get it or not. Are you getting it now? But under the NPV, you get the absolute amount, the Naira return on that project. Are you getting it now? So if you are considering two investments, one is telling you that you get 10 million return. Are you getting it now? The other one is telling you that it's 50% return. You like, are you getting it now? You will still be doing some calculation that is it going to be this amount or this amount. But under the NPV, you get the absolute amount. This is what's going to hit your bank account. Are you getting it now? And interest of return also is based on what? On assumption. Are you getting it now? So that's another.
I agree with you.
With you. With him. I'm going to say I agree.
But the NPV has its own downsides. I feel like those cash flows most times are forecasted.
Yeah, estimate, yes.
Estimate, basically. Yes. And you don't have, you can't control what to happen in the future also.
Of course.
I'm not saying we can't control the
of course.
So if your forecast, if the assumptions should be implied, that's your cash flows.
Yes.
Are faulty.
Yes.
10 million run into your bank account. Sir.
Of course. Of course.
So but I get the idea, and I would choose IRR over anything.
You choose what?
I would choose the IRR. Sorry, APV. Sorry, over. But those are downsides.
Yes, of course. It has its own downside. Because of that downside, that's why we now have expected net present value. With the introduction of what? Probability. No, with the probability. See, it's a general decision. Are you getting it now? NPV has priority. NPV has priority over internal rate of return. Because of the shortfall of the internal rate of return, that's why we now have modified internal rate of return. Are you getting it now? So any project that modify internal rate of return suggests, NPV also will suggest the same thing. Are you getting it now? So it makes it to be on the same path, same NPV.
Sorry, can I explain this one? It's about to.
Indirectly, I've explained.
They are going there.
Okay, so that is modify internal rate of return. It's an adjustment on the normal internal rate of return that we have. And because of the assumption, now, one of the shortfalls of internal rate of return, we said we assume some rates, right? That is one. The second one is that when you look at the cash flow, we said we have year 0, 30,000, year 1, 2, 3, 10,000, year 3, 12,000. Let's say this one, 5,000. So all the inflow, let's say this one, 14,000. I'm just assuming. Now, there's one thing that modify, try to correct, that if we are looking at the project life, let's say the project is for 5 years. Let's say the project is for 5 years. Are you getting it now? This is the outflow. These are the returns. When you get this return, what do you do with it? A project is 5 years project. Are you getting it now? You spend 30,000 naira to invest. Are you getting it now? In year 1, you get 10,000. That 10,000 that you get in year 1, what do you do with it? You go and keep it under your pillow or what? Are you getting it now? So modify to be more realistic about the project says that there should be an investment assumption. Are you getting it now? That this inflow or this return that you get in year 1 should be reinvested at the cost of capital. Are you getting it now? When you get this one in year 2, should be reinvested. This one in year 3 should be reinvested till the end of that project. That makes sense, Abi? Yeah. Now, that is the assumption that internal rate of return fails to incorporate. But we now have modified internal rate of return that all this return should be reinvested at the cost of capital. At that time, be able to know the total returns from that project. Are you getting it now? And we'll be able to compare it with what? With the NPV. Don't forget, under the NPV, we make use of the normal cash flow from that project. Year 0, discount it, add everything together, get the NPV. That is the NPV on its own. Are you getting it now? But internal rate of return, no, under the internal rate of return, after that, if that gives us positive, instead we will get negative, you reduce the rate. Are you getting it now? No, we increase the rate to get negative now.
Yes.
You increase the rate to get negative, and at the end of the day, we apply the formula. Based on trial and error.
Yeah.
So that is what modified internal rate of return try to what to correct. There is a reinvestment assumption that all this return they should be reinvested. It's just like I'm doing a project. The project is for 5 years. Are you getting it now? At the end of year 1, I get 10,000. What do I do with the 10,000? Are you getting it now? That 10,000 should be reinvested until the end of that project. That is when we can actually determine the actual returns from that project. So that is the use of reinvested at the cost of capital.
Not necessarily, must be that same cost of capital. Maybe.
Yes, it shall be reinvested at the cost of capital. So that is the assumption that modified internal rate of return try to correct. So any project that NPV suggests modified internal rate of return also suggest the same thing. Are you getting it now? So how do you calculate modified internal rate of return? So there are 2 formulas that we can use to calculate that. The assumption is basically based on the investment of returns as cost of what? Cost of capital. So any project that NPV suggests modified rate of return also will suggest the same thing. So the formula, so there are 2 formulas that we can use to calculate modified internal rate of return. So the first one is present value present value of return phase cash flow divided by present value of investment phase cash flows multiplied by 1 plus R all minus what? All minus 1. So we know what is called present value of return phase cash flow. That is the cash flow that they are positive. All those cash flow given to the positive ones. Present value of investment phase cash flow multiplied by 1 plus R all minus 1. Or the second formula. You can determine the terminal value. Terminal value of return phase cash flow divided by present value of investment phase cash flow. All minus what? All minus 1. This is our 1 divided by n.
So help us adjust the board, sir.
One divided by.
Yes, 1 divided by n. The decision still follow the same thing. If your modified internal rate of return greater than cost of capital, you accept the project. If NIRR is less than COC, you will get the project. And if your NIRR is equals to COC, the project is breaking even. In that case, then the independent about the explanation. Now let me explain something here.
Get this second one. Base power.
This power 1 divided by n.
No.
Now,
Sorry, Mr. Razak.
yes, sir.
The second formula, is it terminal value or what? What do you write?
Terminal value of return phase cash flow. Terminal value. What is terminal value? How do you get terminal value?
Class online.
What is it?
Okay. When the two formulas, whichever one that you use, you are going to get the same answer. But when is it advisable to use the first one or the second one? So for the first formula, if you have already calculated NPV, are you getting it now? If you've already calculated NPV, you calculate your NPV, you have your table, US cash flow, discount, everything present value. So you can easily from that table go and pick your present value of the return phase cash flow.
You
add all the return phase cash flow, all the positive cash flow, the present value of it. And the present value of the investment phase, your investment phase, year 0, and if there are other years also, can you get it now? Add them together. Present value, not the original listing. Once you are able to do that, you don't have much thing to do again. It's not going to take your time. If you have already calculated NPV, you have everything in your table already, you can apply the first formula. But the second formula, if you've not done your NPV before and you are to calculate, modify internal rate of return, are you getting it now? This one is going to take your time a bit. You can apply this. The terminal value of the deferred fixed cash flow divided by the present value of the investment paid cash flow. What is the terminal value? The terminal value is the future value of your return. I said that the assumption that the modified rate of return is to reinvest the return and the cost of capital. So what are you doing? You are just saying, let's say the return starts from year one. Let's say the return here is 4,000. Are you getting it now? And the cost of capital is 10%. Are you getting it now? But you have to take note of this. You have to look at one example on that one. So that you don't miss it. Yeah. No. Let's use this. Let's use the same question as we planned. Let's use the same question. I think we are done with all these ones. Discounted payback will be explained when we are looking at that question.
Mr. Azar, what of APV?
Let's take it one after the other.
Another topic on its own.
It's another topic on its own. And just say present value. Present value, APV. APV questions has just been said, I think maybe once or twice over the years. If they said APV question, I bet you won't be able to do any other question again. You will spend the whole 3 hours on that one question.
Sorry, Mr. Razak.
Yes, sir.
So that APV, I think Mr. Toib also wants to take it too. So is it both of you that will take APV or what? Both of you would just APV because he takes APV too. He normally takes APV.
It's not under me, Abi.
No, APV is under investment appraisal. But Mr. Toib normally takes it as a separate topic. He takes APV and he has been mentioning that he will take it maybe next week or next 2 weeks. So maybe both of you should align. Maybe both of you should align on it.
When we get that, okay. Let's continue. Now let's take that question. Like I said, we can use the same question to treat different technique. Are you getting it now? It's just about you getting the understanding of each of them, the application in terms of formula and the how to make decision. That is what you need. Now let's look at that question together. That question. I've shared it. I think it's 2018. Is it 2018? Maybe 2018 or 2019. That would be future. So we have to be very fast. So that's why I share it to people so that we get. Is that what you cannot finish it? To be an assignment for us to pay. Best exam. Can I have it over? Yes, you can have some. But I want us to take that question today. Okay. So you can't wait beyond this. Is that what we are saying directly? I said, what year is it? 2018, May. Okay, question 1. We started a bit late, so let's continue. Okay, so that question, 2018 questions, and now Now, there's one thing about investment appraisal is time consuming. So that is why you have to understand the basis, where to start from, and so that you get that flow so fast. Now that we want to look at the first question, if I find that question, let me also give all this. I don't have time to do that going forward. Now, under every questions in SFL, are you getting it now? It's always ideal to go and look at what the examiner wants you to calculate the requirement. You see required, do this. There's no point you reading the question. You read it. You don't read the question like a logo. Are we getting it now? So when you read what you are required to do, are you getting it now? That will give you some insights about the expectation when you are reading the scenario. Are you getting it now? So don't go and be reading the question. It's not going to take you to anywhere. So read the requirements, and from there you gauge your thoughts, and you'll be reading the questions, highlighting what you need to carry out that computation. Okay. So what are we required to calculate here? The question says.
Now, which question is this, please? Which year?
It's 2018, May 2018. May 2018.
Okay, sir.
Okay, so if you look at the requirement, it says calculate using money cash flow the NPV of the project on December 31st, 2018, and advise the company whether to proceed with the project or not. Are you getting it now? Using money cash flows. In some question, you might not put this there, that's using money cash flow. I think the examiner just wants to maybe to disturb some people and just to allow some people to align. That's why they put it there. Are we getting it now? When we say money cash flow, what does it mean? Eh?
Cash flow, that's
Can you be calculation of NPV in money fast? Okay. Now, when you look at the requirement, it says calculate this. So, money time cash flow, what does it mean? That is, okay, after inflation, that you should inflate the cash flows. Now, okay. So don't forget, I said there are two approaches that we can use. We can use a wheel approach or money times approach. So money time approach means that the cash flow should be inflated. Are you getting it now? Okay. So if you are inflating the cash flows, it means that the discount factor also. Look at the discount factor. The question says an appropriate weighted average cost of capital for the project is 10%. That 10%, is it in money terms or is it in real terms? That is the last sentence of the. Okay. What does it mean? Does it mean?
Real time. The 10% is real time.
It was. Where do you see real time? Did they say real time there?
Please, someone should help us send the question on the platform, please, so that we can follow through, please. Thank you.
Okay. Okay, it says the appropriate. Are you getting it now? So since the statement says appropriate, are you getting it now? So we assume it to be in what? the money tank already. Are you getting it now?
Yes.
Okay. Now, let's now go to the question. It says, Play 2 PLC. Don't forget, this is an NPV question. I will say to calculate NPVs, we need 3 things. What are the things? The number of years of the project, the relevant cash flow, and the discount factor, the appropriate discount factor. So in this question, they've already said the appropriate discount factor here should be 10%. Are you getting that? That one is out.
That's the math now.
Yeah, that is the one. That is what is given at the last sentence there. Yes. An appropriate weighted average cost of capital for the project is 10%. So it's appropriate for this project. So we don't need to determine whether it is real or nominal.
Exactly.
Okay. So we need to determine the number of years of that project. So while we are reading through, we are going to see that, and we determine some cash flow that are relevant and some that are not relevant. It's only the relevant one that we are looking out for. Okay. It says Play2 PLC is a Nigerian company that manufactures and sells innovative products. Following favorable market research that cost 4 million naira. This 4 million naira, is it a relevant cash flow or irrelevant?
Irrelevant.
Research cost.
It's what? The sum cost, the past cost. So it's not relevant to this, so we don't use it in our analysis. Okay, so we carry on. PT has developed a new product. It plans to set up a production facility in Kano. Although its board had contemplated setting up the facility in an overseas country. The project will have a life of 4 years.
4 years.
So the project is what? A 4 years project. It's a 4 years project. Can draw, can take time. So we have year 0, year 1, year 2, year 3, year 4. Don't forget, we are in class. That is why I can still write 5 years. So might not go and determine that now until you know the task. Okay. So that is 4 years. The selling price of the new product will be 5,900 per unit. And sales in the first year to December 31, 2019 are expected to be 120,000 units. Are we clear with that statement?
Yes.
What does it mean?
The units.
For which year? For which year?
For year 1.
Year 1 is not.
And the sales of subsequent.
December 31, 2018. December 31, 2018.
When is year 1? When is year 1? When are they starting this project?
They are starting
December 31, 2018.
31st of December 2018. That's when it starts. So that means we are doing the best one.
Let's continue first.
We are counting them.
So I expect to be 120,000 units, increasing by 5% per annum thereafter. Relevant direct labor and material costs are expected to be 3,400 per unit. And incremental fixed costs are expected to be 16 million per annum. The selling price and cost are stated in December 31, 2018 prices and are expected to increase at the rate of 3% per annum. Research and development costs to December 31 will amount to 25 million. Research and development to December 31 of which year?
Of which year?
So it's what?
The same page amount. So that is the amount to 25 for the entire year.
Your is only your zero.
It's what?
Your is also your zero.
Because we have development of cost. Cost.
So look, there's no, there's a miss in this question, and the miss is to which year? So it should be 2018. December 31, 2018, we amount to 25 million. So it's not relevant. It's to the period, it's to the year in which. No, you can take your assumption because it's not, that place is not clear. Are you getting it now? The research and development can be in 2019. It can be in 2020. Are you getting it now? What if it's what?
2019, we now tell you.
No, it's not in 2019.
2019, then you now tell the something.
So investment in working capital will be 30 million on December 31, 2018. And this will increase in line with the sales volume and inflation. Working capital will be fully recoverable on December 31, 2022. That is the end. So that means we are looking at the start of the budget 2018 and 4 years thereafter, 21, 22, no, 2019, 20, 21, 22. So that is the period we are going for. Yeah, 2018 is year zero. And it's continuing like that. So plant and machinery will cost 1 billion. Oh, sorry. The company will need to rent a factory during the life of the project. Annual rent of 20 million will be payable in advance on December 31 each year and will not increase over the life of the project. So this is this cost, is it relevant or not?
Yes.
It's another cost that is directly attributable to that project.
But there is no incremental value.
No incremental value. So you are going to maintain the same value also. But the question says in advance. So how do you treat it?
So it's the increase over the life of the project.
For 4 years, I mean. You stop in year 3, exactly. You say what?
And will increase over the life.
Will not increase over the life of the project.
Plant and machinery.
Plant and machinery will cost 1 billion on December 31, 2018. That is the initial outlay. The plant and machinery is expected to have a resale value of 300 million as December 31, 2022. At the end of the project, the plant and machinery will attract 20% reducing balance capital allowance in the year of expenditure. When is the year of expenditure? Yeah, is zero. Okay. Reducing balance capital allowance in the year of expenditure and in every subsequent year of ownership by the company, except in the final year when there will be a balancing allowance or balancing charge. So when do you determine that? So meaning that how many times do you charge capital allowance? You start from year 2018 to when?
No, it's 2019 we start. You bought it on the first 4 years. That's your one.
It says you claim capital allowance from the year of expenditure. The year of expenditure is 2018, which is year is zero. And you are expected to claim over the lifespan, the period of that. You start to claim capital allowance from the year of ownership, which is year zero now. Are you getting it now? And the question said that you should not claim capital allowance in the final year. That final year, use it to determine whether there is a balancing allowance or return. Okay. Assume a corporate tax rate of 20% per annum in the foreseeable future, and that tax flows arise in the same year as the cash flows which gave rise to them. So what does it mean? Same year, relevant? Yes. Okay. The directors are concerned by rumors in the industry of research by a rival company into a much cheaper alternative product. However, the rumor suggests that this research will take another year to complete, and if it is successful, it will take a further year before the alternative product comes onto the market. An appropriate weighted average cost of capital for the project is 10%. Evaluate using money market the NPV of the project on December 31, 2018, and advise the company whether to proceed with the project or not. 15.
Rasaq, hello, sir.
Yes, sir.
So the situation whereby they say we should use real time, and now they are giving us inflation. How can we now convert to real time?
Sorry, I didn't get that question.
So this one that they gave us inflation and then the money, the cost work is aligning. What if in a situation whereby they give us inflation and now say we should use real time cash flow? So how are we going to convert it? Sir?
He said the condition for real time is when you are giving just only one inflation rate for all the item of cash flows. That is when you can use the real time. Are you getting it now? So in that case, that condition is not here, because if you look at this question, revenue has its own inflation rate, cost also has its own inflation rate. So we cannot use the real time approach. So we have to use the nominal approach. As the question says, use the money times. Money times is the same thing as the what? As nominal. So go ahead with the as the question says. So when we do the calculations,
It's already done, sir. It is time, sir.
Yes.
Cost, tax, everything, then. Yeah, go and pray. But let's consider never. And so let's try about exactly.
Okay,
Come on, sir. You said it on Sunday, then you come and start to see.
Yes, okay, you know what? Let's just at least because we started late.
So let's do 15 minutes with calculation.
Let's do the calculations. So we could determine the revenue. So we at least maybe 15 to 20 minutes and we can call it a day. Okay. So revenue, we need to determine the revenue based on the format that we have. So when you go to the revenue part, from this second line, that's when the second paragraph there, it says the selling price of the new product will be 5,900 per unit, and sales in the first year to December 31, 2019 are expected to be 120,000 units, increasing by 5% per annum thereafter. So now for the revenue, we have the unit. And so this calculation is going to be in millions, so that because of the 000, so it's going to be in millions. You have to indicate it. Okay. Now, if it's going to be in millions, it says the unit. So we are looking at 2019, right? 2020, 2021, and 2022. So what is going to be the unit? That the years. So what is going to be the unit accordingly?
Sorry. Is this the question? The answer of our
no, it's not the answer of the question. Just the calculations.
Why in this exam? You want to put like. I have my ticket, so it's not a long round. That's right.
Yes. The simple thing is that if it is not required, in the question that show workings, are you getting it now? And you find a way that okay, you know how to determine everything on your calculator and move on. You can apply that. When the question says show working, another thing about working is that everything in total, maybe it's not up to, are you getting it now? And the examiner are actually looking for where to actually add 1 or 2 marks. So they can consider the working that you did as.
At the end of the day, it's not because you won't be able to.
No, I'm not saying that. There are 2 things. Show working. You have to show it. Okay. So for revenue.
Sir, hello, sir. Hello, sir. Please, why are we starting from 2019? Why not 2018?
Revenue, 2018.
Hello, sir. Can you hear me, sir?
Yes. This is working.
Hello, sir. Mr. Razaq, Abi.
I can hear you.
Continue.
Yes, sir. Hello, sir.
Okay.
Please, I have a question.
2018 is year 0. 2018 is year 0, and revenue don't come in year 0. They start coming in from year 1. That is 2019.
Revenue cannot fall in year 0. These are workings. It's not the format itself. Are you getting it now? It's not that we are calculating. These are workings.
They should not respond.
So revenue cannot be in year 0. It should be from year 1 up to the end of the project life. And if you look at the unit as per the question is 120. Say 120,000 year to 2019, and it's expected to increase by what? 5% year after. So that means 120,000 times 1.05 give you the next one. So like that. And that is what 126,000 and what? 132,300. And the last one 138,915. 138,915. That is increasing the unit. Let me write it in front so that there won't be questions. 5% inflation. Are you getting it now? That is the unit. To get the revenue is the unit multiplied. The revenue should be selling price multiplied by the what? Quantity. Are you getting it now? So we are leaving our calculation in millions. Okay, so we are done with the unit. What is the selling price?
5,000.
The selling price. The selling price of the new product will be 5,900 per unit.
7 or 8.
Are you getting it now? What is the applicable inflation rate?
3% per annum. So how much be the difference? 5% in the sales price and cost price. So
Are they of the same inflation? The inflation with respect to revenue is 5%. While the inflation with respect to cost is 3%. So they are not the same. Are you getting it?
the selling price and cost price.
So the cost patients, that is the selling price and cost as stated in December 31, 2018, right? And I expected to increase at the rate of 3% per annum.
So that 3% per annum speaks to the selling price. So selling price increased by
7%.
yes, that is the unit. Selling price to revenue and cost. Are you getting it now? To determine the variable cost. You need the variable cost per unit multiplied by quantity. Are you getting it now? That is for cost. Why for selling price? Why for revenue is selling price multiplied by quantity. Are you getting it now? So, meaning that so both of them are 3%. So when you look at this part, what is it here? The selling price of the new product will be 5,900 per unit, and sales in the that is done. Relevant direct labor and material costs are expected to be 3,400 per unit, and incremental fixed cost production are expected to be 60 million per annum. The selling price and cost are stated in December 31, 2018. That is year zero. Are you getting it now? That is year zero. Right, and I expected to increase at the rate of 3% per annum. So that selling price that you are seeing is for year zero. To get for year one, increases by what? 3%, 3% like that. Okay, so what do we do? The selling price now, you have the quantity.
6,077.
That is 59. That is going to be what?
6,077.
In 2019, it's going to be
6,077.
6,077. What have we done? The selling price given as 5,900 is what is from year zero, and it's expected to be inflated by 3%. There is 3% inflation rate. So that takes us to what? 6,077. Multiply this also by 1.03. What do we have?
6,259.
6,259. By 3%, what do we have?
6,447.
6,447. And the last one is what? 6,440.
It's 41, no, 6641.
Yes, approximate. This is not the one. So what have we done in year zero for people that don't understand what we have done here? What we have done here is this: the selling price given for year zero is 5,900, and it's expected to be inflated by 3%. So what do we do? You are just saying for year one, which is 2019. It's going to be 5,900. To inflate is you compound it. So that is 1 plus what? 0.03. Since we are doing for year 1, this is per 1. So we don't be doing all this again. So 1.03. That is for year 1. And that gives us what? It's 6.077. To get for year 2, are you getting it now? You can bring down this. You can bring down this 6077 multiplied by what? 1.03. And you get the next one. 6259. To get for year 3, bring down this, multiply by that. Are you getting it now? Or better still, you can make this constant. Are you getting it now? And allow this one to keep on changing. So that is for year 2, it's going to be 5,900. 1.03, this is power 2. I'm going to get the same answer. So whichever one that you are good with, you can apply in the exam. Are we okay with this? Yeah. Okay. So if that is the case, so we have what is it called? We have revenue and cost. We can now multiply accordingly. So our revenue then becomes what? Multiply and divide by 1 million.
That's 729. 729.24.
Yes, so 729.24. Okay, so the other one is not. This is the unit. This is the selling price. After we repeated them, as the question says, so we are multiplying them to get the revenue.
789. 789.
789. And this.
It's 5. It's 5.
8 what? 853. And this one when you multiply, what do we have? 923. So that is our revenue for each year. Second one, can do for what? Cost. So for cost also, how do you get your cost? Your cost is variable cost per unit multiplied by what? The quantity. So we can do that one also in what? In millions. So you have to inflate them 1 by 1. Multiply and you need one. Okay, so the unit here also is expected to be inflated by 1 million. 3% inflation, right? Yes. If you are looking at 3% inflation.
The 3% inflation is on cost price, not the units.
It's on cost. So what is the unit? Okay, so the unit, the inflation rate is still the same 5%.
Yeah.
So let's just write. Just replicate this. 132. 300 and 138, 915. Okay. So what is the variable cost per unit? Variable cost per unit is expected to be inflated by 3%, right? Yes. Now, what is the initial amount? 3,400 multiplied by 1.03. What do we have? 3502 followed by
3607
3607 followed by 3715 and what? 3827. So that is the word. The inflated variable cost. So we need to get the word. The total variable cost. So our TVC. When you multiply this by this, what do we have? 420. So 420. Followed by 454. 454. Followed by what?
491.
49. Followed by 532. So we've gotten our variable cost.
Yeah. The next one is what? Is now this one and remember that is costing.
So the fixed cost is
Cost down.
in the question is giving us
16 million. 16 million which is incremental principle expected to be.
inflated by what rate? Is it not item of cost? So the specific fixed cost there, if you look at the relevant direct labor and material costs are expected to be, and incremental fixed costs are expected to be 60 million per annum. The selling price and cost are stated in December. So the same thing applies to the fixed cost. Why? Is it not cost? It's an item of cost. Are you getting it now? So it's an item of cost and it's given as 60 million per annum.
Per annum. Yes, and it's like about 10%. It's going to be increased by I don't think the increase is much. Yes, I'm pretty low. It's going to increase. They said those costs. You look at the cost.
Those costs are stated in year 0. Are you getting it now? Is fixed cost not an item of cost? Under investment appraisal, why will you assume that a cost will not be affected by inflation? We talk about time value of money. Are you getting it now? So there is no cash flow that is not going to be affected by inflation. That's why I said the real approach is very real. Your NPV analysis should be after inflation. You have to incorporate time value of money, and that is your inflation. Are you getting it now? You expected to be the same all through. No, it's a part of cost also.
This is now.
What about the rent that is in the question?
They have said and said that related to that
project.
Now.
It's going to be gone now. That's what I'm saying. But usually of inflation.
No, I said that. I think inflation is not affected by inflation. And what's not the essence of implemental? The essence of implemental is that for doing that project, they are going to procure 60 million naira.
The incremental means that it is relevant to the project. Are you getting it now?
That is thing now. It's trying to. Yes, the reason why we are using the office.
Yeah. No. Incremental doesn't mean that if you increase it. It means that it is relevant to the project. Are you getting it now? No. It's not inflation rate that makes it to be incremental. It's not inflation. Wait. So when you say incremental, are you getting it now? Incremental doesn't mean that it's because of inflation that makes it incremental. Are you getting it now? What makes it means that as the project is expanding, are you getting it now? That cost is a relevant cost to that project. Are you getting it now? And in this case, it's supposed to be 60 million per annum. Are you getting it now? But there is inflation. You cannot say 60 million year 1, year 2 is going to be constant all through. No, that 5% is for unit. Fixed cost it doesn't relate with units. It's the 3% that we are using to show the effect of inflation, which is incremental. So I think, can we finish it by this? Yeah. On our own. Okay, so because of time, so we continue from here next week. But if we can try on our own, no problem, because every adjustment has been treated already. Are we getting it now? So we just need to follow the same step. Which one? Where is it going to start?
Sorry, Mr. Razak.
Yes.
Mr. Razak. So the work in this question now, is it the real terms work? Because are we still going to convert it to money terms? The work in this question.
No need to convert. The person says the appropriate work for this project is 10%. So since it is appropriate, you don't need to do any conversion again.
When the question is advance that's going to pay in advance, it's from year 0.
Okay, because I was thinking since we are using money cash flow, we need to get the money terms, what's it called?
Yes,
Yeah.
but the question says appropriate. Don't forget, when we said 3 things, we said the number of years, relevant cash flow, and appropriate discount factor. So the question says appropriate. You don't need to do any conversion again.
Okay, thank you.
Excuse me. Are we inflating the incremental fixed cost by 3%?
Yes, because it's an item of cost. We increase it by 3% also.
Okay.
Sir, can we get your number?
Tell me to stop the photo.
Yeah, but it's 2018. It should be 2018. It's before, yeah, it's still relevant. It's still relevant. It's 2018. Which one is that? Yeah, it should be other rents. After your revenue cost, specific fixed cost, you now have your rent before you determine your profits.
Thank you, sir.
Are you too?
Hello, sir. Your phone number.
Mr. Razak.
Yes.
Okay, so this fixed cost now is 60 million. And we have to inflate it by 3%. So how do we do it now? So that means, is it going to be like something like 61.8? That's 62, right? Because that fixed cost is in million.
Yes, it's in millions. I get it now. So you are just saying, you are just doing 60. It's 60 that you are using because we are doing a calculation in millions. So 60
okay, that's 60 times 1.03.
Exactly. So you do it across all the years.
Okay, thank you.
All right. There's no time. We try it on our own.
Mr. Razak, can you say your phone number?
They should help us snap and send the workings.
It's 081162914. Okay, so
phone number
is 08121162914. Okay, so we complete this next week. By God's grace. Sorry, let me share this.
Yes, over there.
Okay. So bye. Today.
That is what we got. That's just on December, that's the SO. And this will increase the line with sales volume and inflation. So I'm multiplying by 5% and 3%. Which one is my 5%? Yes, times 4.05. So like that's the question. So now 5 and 3 is what will now be 1, 2, 3, 4. So the 10 million plus.
How about to start for outside?
Somebody else now. So that's about 5. Yes, but the sense still volume and so which is what that's still taking. Which area is taking?
Please, someone should off the recording.